As we edge closer to the weekend, the latest inflation numbers from the U.S. are being digested. So here to weigh in on fundamentals as well as central banks is Keith Bliss of Cuttone & Company. Keith, great to have you here today.
Thanks very much, Remy. Good to be with you as always.
Well, we did get a handful of U.S. economic data releases, and on the heels of those inflation figures that we got this week for the latest month, we did see Fed fund futures climb. But have you changed your expectations for the Fed, at least as we head into the final quarter of this year?
No, I haven't, and I'm on the side of the fence where I believe they will give us another rate increase in December, and the market's starting to digest and realize the same thing. And one thing that has led me to that conclusion mostly is not necessarily the macro data that we get out of the U.S. economy, which suggests that inflation is on a runaway path, or wages are on a runaway path, but more so the Fed speak. I mean, this Fed, the Janet Yellen Fed, has always been pretty clear when they give speeches. So I think the macro data that we saw today, what we hear from the Fed speakers, the macro data that we will get in the coming months will be supportive, and I think December 25 basis point rate increases in the cards.
Okay, Keith. Well, now that we've covered your expectations for the Fed Reserve, I do want to talk about uncertainty. Now, one thing for sure is that we'll continue to see market-moving headlines, depending on whether it's geopolitical or political. So as we head into the autumn, we'll be getting announcements out from global central banks. We have elections in Germany, and we have enough on our plate, given that the debt ceiling expiration is a few months away again. So how are you factoring that into your overall strategy?
Well, I think the way the market is trading now, it's not most of the trading that we see in the market, and this sounds counterintuitive because there has been a lack of participation in it. So any of the trading that we see on a daily basis is very much reactionary as opposed to planning or forecasting for the future. So we'll just have to take each one of those events as they come on a daily basis. The trade has been you just take it one day at a time, and you have to be very reactionary. It's a little unfortunate that that's where we are, but it's also not surprising where we are in the calendar, where the markets are trading right now at all-time highs. We'll probably see institutional managers and hedge fund managers. They're already starting to plan to do what they're going to do from a tax preparation standpoint towards the end of the year, cleaning out all the dead wood in their portfolios.
And very quickly, since you mentioned deadwood, I thought of lumber. I know that you monitor interesting relationships in terms of financial instruments. So are there any pairs that you're keeping your eyes on right now?
Well, the commodity space for me, the only thing that I would really keep an eye on right now are the shiny metals, where they are. We've had them overbought for some time, and they've been staying up there, which tells me that that's a hedge going on right there. We don't see an enormous amount of money going on. I would take a look for that, and if you start to see gold and silver pull back a little bit, I would expect equities to start rallying off the heels of that. The other relationship, which I talk about a lot, are currency pairs, the dollar versus the euro. The dollar has come back substantially over the last few months. It's been well publicized and well written about. We still don't have that oversold, but keep an eye on that. If the dollar ticks down to around 89 and a half on the DXY versus that basket of currencies, that would be a good time to buy equities on the short-term basis, because generally that would signal a rally because the dollar will be oversold.
Very interesting. I'll keep that in mind. Well, Keith, thank you so much for joining me on the trading floor today.
My pleasure.